Franchisors have been actively engaged in the FASB and IASB joint project on revenue recognition, as the industry could experience significant changes. The final standard was issued in May 2014. This podcast will provide you with a high-level summary of the new revenue standard and highlight some impacts the standard may have on franchisors. My name is Lauren Thomas, and with me today is Victor Lorenzo, and we're on the Revenue Project team at DPP. Victor is going to provide some insight into how the new standard will affect franchisors. Victor, can you start by giving an overview of the model?
Sure, Lauren. So the core principle in the model is that an entity recognizes revenue to depict the transfer of promised goods or services to its customers in an amount that reflects the consideration to which the entity expects to be entitled in exchange for those goods or services. Now, to do this, the model has established a 5-step process or model. In step 1, an entity identifies the contract with the customer. In step 2, the entity identifies the performance obligations in the contract. Step 3, the entity determines the transaction price. In step 4, an entity allocates the transaction price determined in step 3 to the performance obligations that were determined in step 2. And then in step 5 and the last step, an entity would recognize revenue when the entity satisfies a performance obligation or the performance obligations in question.
Thanks, Victor. Now let's move on to discuss some of the potential impacts to franchisors.
One area that it's going to be significant to franchisors is with respect to the identification of performance obligations relative to pre-opening services that franchisors often provide to their franchisees. The key question here for franchisors would be to evaluate and determine whether those services or pre-opening activities represent administrative tasks to set up the contract. 2, the transfer of a good or service to the franchisee that is distinct from the franchise right. Or 3, the transfer of a good or service to the franchisee that is not distinct from the franchise right. And so, if the franchisor concludes that the pre-opening services and the franchise rights are distinct, then they would be accounted for as separate performance obligations. And a consequence of this would be that if there's a portion of a fixed upfront payment in connection with the signing of the franchise agreement, an amount could be allocated to the franchise right, and that amount may need to be recognized over the term of the franchise agreement.
Victor, can you explain how you would account for any future sales or usage-based royalties to be earned in future periods?
A franchisor would have to evaluate to determine if the future sales or usage-based royalties are attributable to the franchise right, other goods or services, or both. For sales and usage-based royalties of intellectual property, the standard provides an exception that basically says that revenue is recognized at the later of when the subsequent sales occur and or satisfaction or partial satisfaction of the performance obligation. Now, it's important to note that this is only applicable to licenses of intellectual property that are considered to be distinct. So, for sales and usage-based royalties not attributable to licenses, an entity will have to estimate the royalties and include that estimate in the transaction price, subject to the constraint on variable consideration. Lastly, to the extent the franchise right is considered or is concluded to not be distinct from the pre-opening services, then that franchise right would be combined with those activities and accounted for as a single performance obligation.
Victor, there's one point I would like to highlight before we move on. It's not clear if the franchisor would be precluded from waiting until the franchisee's subsequent sales or usage occurs to recognize these amounts, if the royalties are related to goods or services other than the license. The Transition Resource Group discussed this at their first meeting in July. Further implementation guidance might be needed to clarify the application of the exception. Victor, are there any other points you would like to highlight before we move on?
Yes, Lauren, there are a couple of things that I do want to highlight. First one is, as discussed previously, to the extent the pre-opening services are determined to be set-up activities, then generally the franchise right would be the only performance obligation in the contract. If that's the case, any fixed fees received at the beginning of the arrangement may need to be recognized over the term of the franchise agreement. Also, any future sales or usage-based royalties would be recognized when the subsequent sales or usage occurs. If the franchise right is a distinct license of intellectual property, the franchisors need to determine whether the license provides the franchisee with a right to access their intellectual property during the franchise period or a right to use it as it exists at the time of transfer. This is a critical question because this is how the franchisor will determine how it satisfies the performance obligation to provide access to its intellectual property.
Victor, can you explain the certain criteria in the standard to determine if the license will be an access right, with the consideration being recognized over time?
Yes, there are 3 criteria that are explicitly included in the standard that must be met for the license to be an access right with the consideration recognized over time. First, the contract requires, or the franchisee reasonably expects, that the licensor, in this case a franchisor, will undertake activities that significantly affect the intellectual property. Second, the rights granted by the license directly expose the franchisee to any positive and negative effects of the licensor's activities. And thirdly, those activities by themselves do not result in the transfer of a good or service to the franchisee as those activities occur.
So Victor, based on those criteria, would we expect that franchise rights to represent access rights or rights to use at any given point in time?
We expect franchise rights will generally represent access rights with initial fees or a portion thereof recognized over time.
There is one potential impact I would like to highlight before we move on. Franchisors often require franchisees to pay a continuing fee that's designated for a particular purpose, such as advertising activities for the benefit of the system. These fees are typically managed by the franchisor, but are required to be spent entirely on the specified purpose for the benefit of the entire franchisee system. Victor, can you explain how a franchisor will account for these contributions under the new standard?
Yes, Lauren. And before I do that, I think it's helpful to describe how those are generally accounted for under, prior GAAP. So under prior GAAP, there is specific transactional guidance where these amounts that are designated basically for a specified purpose are generally recorded as a liability against which the specified costs, in the case of, the common, as you described, advertising funds, those advertising expenses are charged, and not as revenue and cost or expenses of the franchisor. Under the new standard, however, the franchisor will have to evaluate and determine what are the performance obligations, if any, related to these contributions. So, for example, with respect to marketing or advertising contributions, which are very common in the franchisor industry, often the franchisor has ultimate discretion over how these contributions are spent. So, for example, franchisors may consult with, a council or some type of organization or board that represents the interests of the franchisees, but its marketing department, the marketing department of the franchisor, basically maintains creative control over the type, content, extent, and timing of advertising, and also has control over supplier selection. So the point is that in these cases, if the franchisor is not transferring control of the advertising to the franchisee, it appears like there is not a performance obligation, but this is just really part of the overall obligation of the franchisor to undertake activities that significantly affect its intellectual property to try to enhance the franchise brand, such as, for example, developing new menu items in the case of restaurants, promotions, to advertise and manage the brand, etc. So the associated contributions would be another form or type of sales and usage-based royalty that would likely be recognized as revenues when the subsequent franchisee sales occur. Another view of this issue, or another alternative view of this issue, would be to evaluate them under the standards principle versus agent guidance, which will often result in a conclusion that the franchisor is acting as a principal because it has control of the contributions. So under that view, you basically would get to a gross presentation This treatment would basically be a very significant change from current practice for many franchisors. And, the impact of this change, I think, could be particularly large for entities with highly franchised models, which could basically experience large increases in the amounts of revenues and expenses reported.
Let's move on now to talk about the effective date.
Yeah, the effective date of the standard for public companies is for periods beginning after December 15 of 2016. So a calendar year company would adopt in 2017. It's important to also note that under U.S. GAAP, early adoption is not permitted. For all other entities, non-public entities, there is a 1-year deferral period for annual periods. So for a private company, that would be, or the adoption would be in 2018 for a calendar year company. And there's also a deferral in terms of interim periods. So a private company would adopt the standard at interim periods starting in 2019. A private company can adopt in 2017 at the time public businesses adopt the standard.
Can we briefly touch on the disclosure requirements of the new standard?
Yes, I think the highlight here is that disclosures are going to expand significantly, Lauren. There are quantitative disclosures that will be required, such as disaggregation of revenue, information about contract balances, contract costs, and the transaction price allocated to the remaining performance obligations. One thing I wanted to note here or highlight here is that those disclosures are the same for both annual and interim reporting periods. There are also several qualitative disclosures, so what's important here is that as companies think about their systems, processes, controls, they should also be thinking about the information that will be necessary to comply with the new disclosure requirements.
The last item I'd like to discuss today is transition approaches. Victor, can you walk us through the different approaches?
There are 3 transition approaches provided in the standard. The first one is described as a full retrospective approach, and that's one where an entity would recast all contracts for all prior periods presented. The second alternative is a retrospective approach using one or more practical experience provided in the standard. For example, one of the practical experience provides that an entity would not have to recast contracts that begun and ended in the same annual period. And the third and last alternative would be a cumulative effect at the date of adoption. Under this approach, an entity would record a cumulative effect adjustment to the balance of beginning of retained earnings on the year of adoption. It's important to note that even under this approach, an entity would have to provide disclosure in that period of adoption of the impact of the change on each financial statement line item. So what's important to note here is that even under the cumulative approach, an entity is still required to account for revenue transactions both under the new standard and legacy GAAP to determine the effect of the accounting change.
Thank you, Victor, and thank you, the listener, for joining our podcast today. For additional information, refer to KPMG's Financial Reporting Network, including the latest on revenue page, which links to KPMG's analysis of the new standard, including defining issues, webcasts, and other podcasts.